Hey, quick question. When did you last hold actual cash?
Like physical paper money, not tapping your phone, not swiping a card, actual bills in your hand. For a lot of people, the answer is a while ago. And that's wild when you think about it, because money is literally the thing that makes modern life work. You need it for food, shelter, everything. But most of us have no idea where it actually came from or what it even really is. So today, we're going on a journey all the way back to the beginning, before banks, before coins, before paper. Back to a time when trading meant looking someone in the eye and saying, "Okay, I'll give you 3 fish for that goat." This is the history of money, and I promise by the end of this, the way you think about the cash in your wallet or the numbers on your banking app will never be quite the same. Let's go.
Okay, imagine you're a farmer. It's 5,000 years ago. You've had a great harvest. You've got more wheat than you could ever eat. But what you really need is some meat. So you go find a hunter. Here's the problem. The hunter doesn't need wheat right now. He's got plenty. What he needs is a new spear. So now you need to go find a spear maker. But the spear maker needs leather. So you need to find someone with leather, who probably needs wheat. Maybe. This is called the double coincidence of wants, and it was the single biggest problem with the barter system. For a trade to happen, both people had to have exactly what the other person wanted, at exactly the same time. It worked okay in small villages where everyone knew each other, but as communities grew, as people started specializing, some farming, some hunting, some making tools, barter got incredibly inefficient. And don't even get me started on trying to make change. If your cow is worth 30 chickens and someone only wants half a cow, well, that's a problem. People were smart, though. They figured out a workaround. And it started with stuff everyone already wanted. The first real step toward money was commodity money. The idea was simple. Instead of trading your specific thing for my specific thing, we all agree on one item that everyone accepts as a medium of exchange. Different cultures landed on wildly different answers. In ancient Rome and across the Middle East, salt was gold, literally. It preserved food before refrigeration existed, which made it incredibly valuable. Roman soldiers were sometimes paid in salt, which is actually where the word salary comes from. Sal, Latin for salt. In China, Africa, and South Asia, cowrie shells became the dominant currency for thousands of years. They were small, portable, beautiful, hard to fake, and came from the ocean, which meant inland communities couldn't just go make more of them. Natural scarcity. Across ancient Africa and early Europe, cattle were wealth. The more cows you had, the richer you were. This is actually why the word capital comes from the Latin word for head, as in head of cattle. Caput. And in Mesopotamia, modern-day Iraq, barley was so commonly used as payment that they literally wrote debt records in barley quantities on clay tablets. Some of the oldest financial documents in human history are grain receipts. But here's the thing. All of these had problems. Salt gets wet. Shells break. You can't split a cow in half. Barley is heavy. As trade routes got longer and economies got bigger, people needed something better. Something that was durable, portable, divisible, consistent, and rare enough that everyone trusted its value. Enter metal. Somewhere around 5,000 years ago, people started using copper, bronze, silver, and eventually gold as a medium of exchange. These metals were rare enough to be valuable, hard enough to last, and could be divided into smaller pieces without losing their nature. But the real leap came around 600 BC in a kingdom called Lydia, in what is now Western Turkey. The Lydians did something nobody had done before. They minted standardized coins. Before this, if you wanted to use metal as money, you had to weigh it every single time. Every transaction involved a scale and a negotiation about purity. Exhausting. The Lydians stamped coins with a fixed weight and a royal mark guaranteeing their value. No scale needed. The king's face on the coin was essentially a government guarantee. This was a massive deal. Within a century, the idea spread to Greece, Persia, India, and China. Each empire minted its own coins: the Greek silver drachma, the Roman gold aureus, the Islamic gold dinar, the Chinese bronze cash coin. For the next 2,000 years, coins were the backbone of global trade. But carrying sacks of metal coins across long distances was dangerous, heavy, and inconvenient. And as economies grew larger and more complex, people started asking, do we really need the metal itself? Or just something that represents it? The answer came from China. In the 7th century AD, during the Tang dynasty, merchants dealing in large volumes of trade came up with a clever solution. Instead of hauling heavy coins across the country, they'd deposit their coins with a trusted merchant or official, basically a proto-banker. In return, they'd get a paper certificate, a receipt. It said, essentially, the bearer of this note is owed this amount of coins. The Chinese called these jiaozai. And here's where it gets interesting. Merchants started trading the paper receipts instead of going back to collect the coins. Why carry the metal when the paper works just as well? As long as everyone trusts the person who issued it? By the 10th century, the Chinese government saw what was happening and did something bold. They took over the issuance of paper money themselves and made it official, legal tender. The world's first government-issued paper currency. Europe was about 600 years behind. It wasn't until the 17th century that goldsmiths in England started issuing similar paper receipts. And those receipts evolved into what we now call banknotes. And right here, in this moment, is where the most important shift in all of monetary history happened. Money stopped being a thing with inherent value, like gold or silver or salt, and started being a promise. A piece of paper that meant nothing on its own, but everything if people trusted the institution behind it. That word, again, trust. Hold on to it. We're going to keep coming back to it. By the 1800s, most of the world had settled on what's called the gold standard. Every paper currency was directly tied to a fixed amount of gold. The British pound, the US dollar, the French franc, all of them redeemable for actual gold at a fixed rate. This system had a real appeal. It put a hard limit on how much money a government could create. You can't print more dollars than you have gold sitting in a vault somewhere. It kept inflation low and gave international trade a stable foundation because everyone knew exactly what each currency was worth in terms of a universal standard. But it also had serious drawbacks. If the economy needed more money to grow, more currency in circulation to fund businesses, create jobs, build infrastructure, the gold standard said no. Not unless you find more gold. It was rigid, inflexible, and in times of economic crisis, that inflexibility could be catastrophic. The system started cracking during World War I when countries needed to print money to fund the war. It was patched back together in various forms throughout the early 20th century. But the killing blow came on August 15, 1971.
President Richard Nixon went on television and announced that the United States would no longer convert dollars into gold. Just like that, the link was cut. Economists call it the Nixon shock. Every major currency in the world became what's called fiat money. And that brings us to the system we still live in today.
Fiat. The word comes from Latin. It means let it be done, a decree, a declaration. Fiat money is money because someone in authority says it is. There's no gold in a vault backing your dollars. There's no silver. There's no commodity of any kind. A $20 bill is a piece of cotton and linen that costs a few cents to produce. What makes it worth $20? 3 things. First, law. The government declares it legal tender. That means by law, you must accept it as payment for any debt. You can't refuse dollars in the United States. Second, collective trust. This is the big one. Money works because we all agree it works. All 7 billion people on Earth participating in the global economy have, consciously or not, agreed to treat these paper rectangles and digital numbers as valuable. The moment that agreement breaks down, the money collapses. We've seen it happen. In Zimbabwe in 2008, in Venezuela more recently, in Weimar Germany in the 1920s. When trust dies, currency hyperinflates into worthlessness almost overnight. Third, economic output. Fiat money isn't backed by gold, but it is backed by something. The productive capacity of an entire economy. The farms, factories, services, technology, and labor that a country produces. A dollar represents a claim on a tiny slice of all that real-world value. It's abstract. It's philosophical, even. But it works. For now. And understanding that it works because of trust, not because of any physical thing, changes how you see every financial crisis, every inflation scare, every bank run in history.
So, who manages all this fiat money? Who decides how much exists, what it's worth, and how it flows through the economy? Central banks. In the United States, that's the Federal Reserve, the Fed. In Europe, the European Central Bank. In the UK, the Bank of England. Every major economy has one. Central banks are not commercial banks. You can't walk in and open an account. They operate in the background, pulling levers that affect every loan, every mortgage, every savings account, every business investment in the country. Their main tools are simple in theory and brutally complex in practice. Interest rates. When the Fed raises rates, borrowing gets more expensive. People take fewer loans. Businesses invest less. The economy slows down. Prices stop rising as fast. When the Fed cuts rates, borrowing gets cheap. People spend more. Businesses expand. The economy heats up. But if it heats up too much, you get inflation, prices rising faster than wages, eroding the purchasing power of every dollar you hold. Money supply. Central banks can also directly increase the amount of money in the system, a process sometimes called quantitative easing, or QE. They essentially create new money electronically and use it to buy financial assets. This pumps liquidity into the system in times of crisis. It's a constant balancing act. Too little money and the economy stagnates. Too much and inflation spirals. Get the timing wrong and you tip into recession. Central banks have enormous power, and they make mistakes. The 2008 financial crisis, the inflation surge of 2021 and 2022. These are the real-world consequences when monetary policy goes wrong. Here's something that will mess with your head a little. About 92% of all the money in the world does not physically exist. There are no coins, no notes, no vault somewhere stuffed with cash. It's just numbers, entries in databases, digital ledger entries at banks and financial institutions around the world. When your employer pays you, no physical money moves. A number goes down in their bank's database. A number goes up in yours. When you pay for groceries with your card, same thing. The grocery store's account goes up. Yours goes down, instantly, automatically. This process is called fractional reserve banking. Here's how it works. When you deposit $100 at a bank, the bank doesn't just store it. It keeps a fraction, maybe $10, in reserve and lends out the other 90 to someone else. That someone deposits the 90 at their bank, which keeps 9 and lends out 81. And so on. Each step of the way, money is being created. Not printed, created. Out of lending, out of trust, out of debt. It sounds insane. It kind of is. But it's how the modern economy functions. Almost all the money in circulation was created this way, not by government printing presses, but by banks making loans. The physical cash in your wallet, that's almost a relic, a nostalgic artifact of an older system. The real money is invisible. And then in 2008, everything got even more interesting. A person, or possibly a group of people, using the name Satoshi Nakamoto, published a 9-page document on the internet, the Bitcoin White Paper. The question it was trying to answer was this: What if money didn't need a central authority at all? No government, no bank, no institution you had to trust. What if trust could be built into the math itself? Bitcoin uses a technology called blockchain, a public distributed ledger that records every transaction ever made, maintained simultaneously by thousands of computers around the world. To fake a transaction, you'd have to rewrite the entire history of the blockchain across thousands of machines simultaneously. Mathematically, practically impossible. And unlike fiat money, which central banks can create in unlimited quantities, Bitcoin has a hard cap built into its code. There will only ever be 21 million Bitcoin, ever. Scarcity enforced not by a vault of gold but by mathematics. Now, whether Bitcoin or any cryptocurrency becomes genuine mainstream money is still very much an open question. It's volatile, it's complex. Regulators are still figuring out what to do with it. But as an idea, as a radical rethinking of what money is and who controls it, it's one of the most significant monetary experiments in history. And it perfectly echoes everything money has always been about: trust, agreement, a shared belief in a system that has value because we decide it does. So here's the big idea, the thing I want you to walk away with. Money has never, not once in its entire history, been about the thing itself. Not the cowrie shell, not the gold coin, not the paper note, not the number in your bank app. None of those things have inherent value. A gold bar on a desert island where you're the only person is just a heavy, shiny rock. Money is a technology, a social technology. It's a tool that humans invented to solve a coordination problem. How do we exchange value with strangers, across distances, across time? And every version of money in history, every single one, has worked for exactly one reason: because enough people agreed that it worked. The moment that agreement held, economies flourished. The moment it broke, currencies collapsed. We've gone from seashells to gold, to paper, to digital numbers, to cryptographic code. Each transition happened because the old system hit its limits, and human creativity found something better. And here's the thing that should genuinely excite you: we're not done. Digital currencies issued by governments, programmable money, decentralized finance. The next chapter of monetary history is being written right now. And unlike every generation before us, we get to watch it happen in real time. If you want to understand the world, really understand it, understanding money is one of the most powerful places to start. Thanks for watching. If this blew your mind even a little, subscribe, because next time we're going even deeper.